Good afternoon, students. Welcome back to the discussion on audit. So we have been discussing chapter 7, and in this chapter, some of the things you can say we have just covered were mostly about the subsequent events and briefly about the going concern. Okay, so today we plan to continue our discussion on going concern. In the previous session, we just touched upon some of the accounting requirement, you can say, or the reporting requirements from the management perspective, because that is something which the auditor would always want to look at. Okay, so before we get on to this, let's do a quick recap. Yeah, in this chapter we discussed that there are a lot of topics, and when we are talking about those topics, they will largely be covering the various reporting requirements. Okay, not really limited to a particular line item of the balance sheet or a P&L. So that's the structure of the discussion that we will have in this chapter. Yeah, so let's quickly do a recap. And in terms of the recap, I would request you to answer some of the questions. Okay, let me just share this working file first. All right, so now quickly, can you tell me what are the subsequent events and what is it that the auditor is required to look at in respect of the subsequent events? Over to you quickly. A brief overview, or you can say a quick summary of the subsequent events, if you can help me with that. Great, I can see the responses coming in. Yeah, but the response I want is around the subsequent events. So now, what are these subsequent events? What are the audit requirements? So I'm not really asking you about the accounting requirements, or you can say the requirements from management's perspective, from the auditor's perspective. No, from the auditor's perspective. So I think Priyanshi has tried to answer, but from the auditor's perspective. So what is it that the auditor needs to look at? What are going to be the audit procedures? What are going to be the situations? Priyanshi has answered this. Priyanshi is saying events which occur after the financial statements. Now, when you use some of these terms after the financial statements, now what are these? Because technically you need to be correct, isn't it? Okay, so Ananya says events which are occurring between the date of financial statements and the date of auditor's report. Now, here again, when you say date of financial statements, are you trying to say the reporting date? I'm assuming that, yeah. Now, in respect of this, what is it that the auditor is required to do? Tell me. So, what are going to be the audit procedures? What are going to be the auditor's considerations in relation to some of these events? Quickly. Yeah, so we can just say there are three categories in a way. One that is about the events after the balance sheet date, but till the time financial statements are not signed. Okay, so that was first category. In that case, everything is open. Yes or no? Everything is open because the financial statements are not yet signed, they are not finalized, audit is going on. So any course correction, any sort of error, any event which is required to be considered therein can definitely be incorporated. Yes. And in respect of these events, AS4 will get triggered. Correct. So that is what the auditor is also required to look at. And if in case these things are not fixed, then the auditor will have to look at the impact, and accordingly his reporting requirements. Means if these are not accounted for in an appropriate manner, then of course auditor will have to check whether he wants to qualify, or whether the impact is not so significant, he may looking at ignoring those impacts. Correct. Now, the other events are those which will arise after the financial statements are signed, but till the time they are not authorized. Correct. Now here again, auditor will have to just look at in terms of whether there is a significant event which could impact the reporting requirements of auditors. And if that is the case, there again, auditor is not required to perform the auditor's procedures. Auditor will have to just see if any such information comes to his mind. Okay, or maybe some of this sort of communication is made to auditor. Okay, so only then he'll be picking up, because as such, auditor is not really required to perform procedures during that period. Why? Because once the audit report is finalized, audit report is signed off, so things are done. Okay, and the third category could be the one wherein the financial statements are authorized, but they have not been issued. Yeah, or if those are issued, then what is going to be the case scenario? So now in all of these case scenarios, because the work of auditor is already completed, he is done, he's closed his audit. So that's why anything which will require the auditor will be only those points which will come to his attention. Okay, not because he is performing certain procedures, but maybe something significant has impacted the financial statements, and which may therefore require the considerations of the auditor. Correct? Yeah. So this was briefly about the subsequent events. Now, next. Next was about the going concern. So in the previous session, we also touched upon going concern. As far as the reporting requirements are concerned in relation to the financial statements, we talked about going concern. So can you quickly help me understand what is this going concern? How does it really impact the financial statements? What all things are required to be considered in relation to the going concern? I'm not talking about the audit procedures, because that is something we are going to cover now. But in relation to the going concern, the accounting considerations. Okay, so Priyanshi says it means perpetual succession of the company. Okay, Abhishek says going concern means business is going to be never ending. Okay, what about others? Quickly. Now, going concern again is an important topic. Why? Because this may significantly impact the financial statements. Prem says it tells that entity will continue its operations for the foreseeable future. Right? Okay, so let's quickly get into this going concern once again. Now, in relation to going concern, let me just see a couple of more responses. Okay, Prem says generally it's a period of 1 year. Priyanshi says long-term perspective is required to be looked at as to whether the company is earning profits or not. Okay. Now let's try to understand about the going concern. See, as around the going concern, we discussed that it's a fundamental accounting assumption. Remember, there was a chart we discussed. Okay. And in relation to this fundamental accounting assumption, we also discussed that it is not required to be disclosed. Yeah. So if you talk about going concern assumption, okay. So if this is appropriate, if the going concern assumption is appropriate, in this case, will there be anything required as far as the financial statements are concerned? The answer is no. Okay. So therefore, in this case, we can say no disclosure is required. We can say no disclosure is required. But if the going concern assumption is not considered to be appropriate, okay, in this case, can you tell me what are the accounting requirements What is it that is required in the financial statements? Over to you quickly. So if the going concern assumption is not appropriate, then in the financial statements, what are the accounting requirements? Quickly, over to you. Yes. What are the accounting requirements? What are the reporting requirements in this case? Quickly, huh? Okay, so now in this case, disclosure will be required. Why? Because now you need to specify to the users that the going concern assumption is not appropriate. Okay. Yeah. Otherwise, it's not required. Why? Because it's fundamental accounting assumption. So if it's not there, that is when you disclose it. Further, Prem says items of balance sheet will go at NRV. Correct? Yeah. Now, in this case, what do you mean by going concern assumption is not appropriate? It simply means that now company is not going to continue to run for a foreseeable future. So that's why what should be the approach? Therefore, management should consider this approach as if the company is going to get liquidated in a near future. Correct? And if that is to happen, then there is no point keeping the assets and liabilities at historical cost. So that's why, what do? That's why assets, liabilities, you will bring them at realizable values. Correct? Yeah. Now this is what is required to be done in the financial statements. Okay. But we are now looking at the audit requirements. Okay. So now what we need to understand is that as far as auditor is concerned, what is required to be considered there? Okay, Dhanush is asking, sir, what is this appropriate and non-appropriate? Sure. So we are going to discuss this in more detail, Dhanush. Yeah. Now, first of all, whether this concern, okay, so you can say this sort of concern as to whether the company will be able to continue to operate, this needs to be analyzed. Yes or no? Only then you will be able to say that going concern assumption is appropriate or not. Yeah, why? Because if the company is going to operate, yeah, company is going to continue to run its business in the foreseeable future, then what will you say? Going concern assumption is appropriate. Yeah. Otherwise not. Otherwise not. Yeah. Now, who has the responsibility to prepare the financial statements? Tell me. Who has the responsibility to prepare the financial statements? Tell me. Sunil says it's the management. Yeah, Dhanush says it's the auditor. Very good. Shreya, Almaz, Prem, they are saying it's management. Priyanshi says, but sir, it is fundamental, which means it will be always appropriate. See, it should be always appropriate. Yeah, because it's a fundamental assumption. So ideally, it should be there. But what if it's not there? Is that possible? Yes. But is that quite common? May not be. Okay. But to say that this situation is never going to arise or is never possible will be incorrect. Okay, Priyanshi. And we are going to look at various situations today through which you will get to understand as to why this fundamental accounting assumption may not be appropriate at times. Okay. So the point is that whether this going concern assumption should be considered or not. Who has to look into this? It's the responsibility of the management. Yes or no? Why? Because this financial reporting, if you talk about the financial statements, it's the responsibility of the management. Correct? So therefore, the first situation which arises is to check Okay, I think this is quite small. Just give me a minute. Okay, so the first situation that arises is to check management's assessment. Now, what do you mean by management's assessment? See, every time for an entity, irrespective of whether that entity is large or small, irrespective of whether that entity is making profits or losses, management has a responsibility. Responsibility around what? Responsibility around checking whether this going concern assumption is appropriate or not. So therefore, if the auditor gets involved, or you can say if the audit is going on, so it cannot happen that the assessment of this going concern will be carried out by the auditor. No. Why? Because it's something which the management has to do. Management has to evaluate. Management has to consider as to whether any impact, depending on the situation which is there in a company, may arise on the financial statements or not. Okay, so therefore, what is going to be the first step? First step has to be the management's assessment. So this you can say the first step. Okay, and therefore, whenever auditor will get into this assessment, so auditor will have to check this management assessment first of all. Okay, so this is what is required to be done by the auditor to begin with. Yeah, so this is what he needs to check. Yeah. Now, when the management assessment is required to be checked, the next question arises, what is it that the auditor will check and how should the auditor approach this? Now here again, you can say as far as audit is concerned, okay, so the auditor needs to go back to its planning. Yeah, so auditor needs to go back to its planning. Yeah, so the planning exercise which the auditor would have performed, or you can say this planning is going to be the stage wherein this management assessment should also be looked at, or you can say wherein the auditor should have this evaluation that something like this situation may arise, or you can say that there is a risk in relation to any such type of situation. Yeah, so therefore risk assessment, remember risk assessment, remember risk assessment, tell me quickly. Do you remember risk assessment? Risk assessment is something which the auditor will do at the time of planning. Yes or no? Yeah. Now, during planning, auditor will also be looking at this particular risk. Risk assessment doesn't mean only the financial statements will be looked at or those areas. Each and every type of risk in relation to the company which may have an impact on the financial statements is required to be considered. So therefore, this activity will start at the planning stage. And during this planning stage, the risk assessment exercise which the auditor will do should also include one of this consideration as around the going concern. Okay, yeah. So this is something which you need to now understand as to where does it start from? Who is going to look at it first? That's the management. And if the management is looking at it first, it starts with the management first. Then of course, it doesn't mean that the auditor will just simply go on to understand during the course of his field work. No, it is something which the auditor will begin with at the time of his audit planning. Okay, or you can say this consideration will also form part of the audit planning exercise. Clear? Yeah. So you can say responsibility for this is that of the management to begin with. Why? Because financial reporting is the responsibility of the management. Now, please remember that at times reporting framework may not specifically require this going concern to be assessed. Still, it's required to be done, both on the part of the management as well as the auditor, because it's quite critical. Correct? Now, let's try to understand as to what are going to be the factors which the management may consider while making this assessment. Nature and condition of the business, size and complexity of the entity. There could be some external factors. Maybe government policies have got changed. Maybe there's a technological change. Okay. There could be a significant litigation on the company which may have a significant bearing as far as this going concern is concerned. Okay. Or there could be some uncertainty. There could be an event which is attached to the entity which is uncertain at this point of time. Okay, so let's try to understand all of these factors one by one. And let's also try to understand as to how these factors can bring in this going concern assumption to be not considered as appropriate. Let's suppose you look at the business of the company. What do you find? It's highly competitive. Okay. So the business which the entity is into is very, very competitive. Yeah. There are significant pressures as around the margins. The nature of business, or you can say the condition of business, is such that the cash flows have got reduced quite significantly. Okay. So therefore, it may become very, very difficult on the part of the entity, or you may say this may be becoming increasingly difficult on the part of the entity to survive in this environment. Possible or not? Tell me. Possible? Yeah. Sometimes what may happen is government may change its policy all of a sudden. Okay, for example, government may bring in certain norms as around the environment. Yeah, as around the environment. Because of which, so for example, if you look at some of the states, cities, so EV, or you can say the vehicle on the energy side, okay, or you can say the vehicles with the electrical energy are being supported. Okay, in fact, they are being pushed. So, as a result of this, companies which are not on that sort of business or the business model are going to suffer. Sometimes technological advancement may take place. Maybe a new technology has come up, and therefore the old technology or the companies which are on old technology may not be able to survive anymore. Yeah. Sometimes what may happen is that the company has got into a litigation. It's a significant limitation. Why it's a significant? Because the impact on the company, if the company loses the case, could be very, very significant. Yeah. And thereby, it may challenge the going concern assumption. It may happen that if the company loses the case, company may not be able to survive anymore. Say, for example, a GST demand has been raised on the company and the amount is quite significant, exorbitant, you can say. Yeah, so very, very difficult for the company to survive in those scenarios. Okay. Now, in all of these situations, okay, who will do the assessment? Of course, it's the management. It's the management who is required to do this assessment, because it's the management who will be able to assess as around the going concern. Because what is the objective? Objective is very simple, that if the financial statements are getting finalized for 31st March, then in the foreseeable future, company should be able to continue to run its business. Yeah. Okay. Company should be able to continue to run its business. Only then this going concern assumption can be considered to be appropriate. If for any reason this ability on the part of the management to continue to run this company is not found, or you can say significantly impacted, then what will happen? Going concern assumption is going to be significantly impacted. Correct? Yeah. So some of these factors that we just looked at are required to be considered by the management. And how will the auditor get to know about it? Auditor will also have to do this assessment. Yeah. And when will the auditor do this assessment? At the time of risk assessment. Means at the time of audit planning. Okay. Yeah. Wherein he will have to understand, he will have to inquire from the management, he will have to just go through the financial statements, maybe the preliminary one which he may have received, and he also needs to understand the industry, he also needs to understand the business of the company as to whether there are any events, conditions that may cast significant doubt on entity's ability to continue as going concern. Okay. The moment we say that yes, there are some events, there are some conditions which may impact significantly this ability of the entity, then what will happen? We are in a way saying that there's a risk. Now, once again, it's a risk. Okay, so as to whether this is actually going to impact or not needs to be analyzed. But at least risk is there. Yes or no? So that risk needs to be evaluated. Yeah. And for this to be done, you can say for this part to be done, what is going to be the first and foremost step? That's to check management's assessment. Okay, so in the previous slide, the things that we discussed, that is something with which the auditor has to begin with. Okay, so if the management has done the assessment, it's very good because auditor will then use that. If the management has not done the assessment, can you tell me what is required to be done? If let's suppose audit has started, audit team went to the management, had a discussions with them, and found out that management has not done the assessment. So tell me, what is it that you will want to do as an auditor? Over to you. In such a case, what will you do? Quickly, let's suppose you go meet the management and you find out that the management has not done anything. Okay, now you have to do the planning, you have to prepare your audit plan, you have to design your audit procedures. Now in this case, what will you do? Tell me, what will you do? Priyanshi says SA 315 is first and foremost thing before auditing any company. No, which is fine, but tell me, in such a case, what will you do? SA 315 is first and foremost is understood, but you tell me, what will you do in that case? Yes, quickly, huh? What will you do? Anyone? Sunil says, we will design the audit plan. Now, of course, you will design the audit plan, but for audit planning, you need this assessment from the management that is missing. So, Prem says, no idea. See, in such a case, auditor will have to ensure, in fact, you can see it's written over there. Auditor will have to ask the management to do this assessment. Why? Because eventually this assessment has to come from the management. It's not possible that if the management has not done the assessment, so the auditor will do. How will the auditor be able to know that in the future, how are the operations going to be structured? Okay, so it's all about a future position. It's all about the future events. It's all about anything which is in relation to the management which is going to happen in future. So how can the auditor know about it? It's the management who knows about it. Yes or no? Auditor can of course go audit that. Auditor can of course go check that. But till the time it's not done by the management, it's not prepared by the management at the first level, how can the auditor do that? Do you think auditor can himself prepare this working? Tell me. Do you think it's possible on the part of the auditor to do this assessment on his own without the one which is done by the management? Do you think it is possible? So even if let's suppose auditor tries to do that, do you think it's possible? Prem, Shreya, Sunil, they are saying no, of course. Why? Because in the future, what is going to be the revenue? Okay, what is going to be the profitability? How are the cash flows going to be there as far as the company is concerned? Auditor cannot understand because this is something which has to come from the business. Yeah, and it's only the management knows. It's not that auditor knows about it. Auditor can always look at the historical data, do the analysis. Yeah, but this future event, future activities, future data, that's not the job of the auditor at all. Correct? Okay, now If let's suppose management has done the assessment, so auditor will discuss and evaluate that. If the management has not done the assessment, auditor will have to ensure that management does this and then get on to the discussions with the management around that, evaluate the assessment of the management. Okay. Now in this case, a question arises that what is the meaning of assessment of the management? Yeah, and I'm sure you must be thinking that when you are saying management needs to do the assessment, management has to prepare something. So what is it that the management will do? Yes. See, it's all about drawing the projections. Let's try to understand this. Okay. So today, if let's suppose we are standing on 31st March, what do we need? We need that at least for next 1 year, and of course for a period beyond that, but at least for next 1 year, whether the company will be able to continue or not. Yeah, that's the requirement. Now, how will the management assess this? Management can always prepare the projections. Now, what do you mean by projections? Projections means you can say assuming the numbers which are going to be there in the future period. So you can say management can prepare the P&L for next 1 year. Now, how will that be possible? That will be possible based on some assumptions. Okay. For example, budgets are prepared. Budgets are always prepared for the future period. Okay. Similarly, projections will be prepared. Projections will not be there only for P&L. Those will also be there for cash flows. Okay. Those will always be there for the financial position. Means how is the company going to get placed in the next 1 year or so. Yeah. Now, all of these projections, what are they based on? They are based on some assumptions. Always. See, if the numbers are not actual, then of course some of the assumptions you will have to take. Only then you will be able to draw the numbers for the future period. Otherwise, how will you draw the numbers for the future period? Possible? The answer is no. Not possible. Yeah. So now the question arises that if the management is preparing the projections, let's suppose you go ask the management. Okay, and generally, practically, what will happen? Management will give the projections for next 5 years. Or you can say next 3 to 5 years. Okay, now in this case, when the projections are given for next 3 to 5 years, some assumptions would have been considered. Now the first point is to understand those assumptions, to understand those workings of projections, and to also understand as well as evaluate whether these projections are, you can say, are the ones which you believe as an auditor, or which as per your assessment as an auditor, whether the management will be able to achieve that or not. Yeah. So what does it mean? Say, in the past years, let's suppose year on year, what do you find? management has been making losses. Okay, let's suppose in the past years, in the last 3 to 4 years, what do you find? Management has been making losses. But now, when you are asking for the projections, means the management assumptions. So, what has happened? For the next year or for the next 3 years, management is showing a profit. Of course, they will want to show a profit. Now, in this case, as an auditor, you need to go and check that why are these projections showing a profit? So there could be various reasons for that. Maybe the management is projected more sales, which were quite low in the previous years. So how will you get to know about it? You can always look at the customer contracts which are in hand, or if there are any long-term contracts, or the basis which the management would have applied in projecting those revenue numbers. Similarly, on the cost side, management would have considered costs for the next 1 year, for the next 2 years, 3 years, 5 years. Okay. So therein, if you believe that the numbers are in line with the past year's data, it should not happen that in the past years there were certain costs which the management has been incurring year on year, but in the projections they have been eliminated. Why? For no explanation. Or even if explanations are there, auditor needs to go and understand that. Why? Because the management will always want to show a glossy picture. Yes or no? Yes or no? Yeah. So that's why all of these things become very important on the part of the auditor. Yeah. Everyone clear so far? Any questions so far? Quickly. Any questions? Any doubts so far? Over to you. No? Okay, great. Priyanshi says no. It's all clear. Anyone else? Any questions? Any doubts so far? No? All right. So now representation is something I'll come to that representation slightly later. Now, let's try to look at some examples. Okay, so we have been talking about events, conditions, which may cast significant doubt on the entity's ability to continue as a going concern. Okay, now the point arises that what could be the examples of those situations, of those events, conditions. So let's try to look at some factors. One, if you look at the financial statements of the company, balance sheet of the company, what do you find? It's a net current liability position. What do you mean by position of net current liability? Means current liabilities have exceeded current assets. I'm sure you are familiar with current liabilities and current assets. Can you tell me what is the impact of a situation when the current ratio, you can say, is negative, or you can say when you have a net current liability position? Can you tell me the impact? Over to you quickly. Tell me quickly. What is going to be the impact of that? Over to you. What does it indicate? What does it indicate? Great. See, if you look at current assets, current liabilities, where are those required? See, the current assets, current liabilities, they are required for working capital purposes. Correct? And if you say that current assets are lower than current liabilities, that is when you will have a net current liability situation. So it would indicate that the company may not have adequate cash flows, adequate working capital to run the business. Yeah, Priyanshi says it indicates that liquidity has gone down significantly in the company. For emergency, company may not have sufficient liquidity. And forget about emergency, even for day-to-day operations, it may be missing. Yeah. Similarly, if you look at a company, what do you find? It's been incurring losses for the last few years. And the net worth of the company has got eroded or substantially eroded. Can you tell me what is a net worth? Anyone? What is net worth in a company? Over to you. What is a net worth in a company? Can you tell me? In a company, what is net worth? What is the meaning, understanding of net worth? Quickly, over to you. In a company, what is this net worth? How is this really relevant? Shreya says shareholder funds. That's correct. So you can say the capital which is inducted in the company plus the reserves which are built year on year. Negative net worth, or you can say when the net worth starts getting eroded, it means that company has not been able to generate adequate reserves. Forget about that. In fact, the capital which has been inducted in the business, that is getting reduced day by day. Yeah, which is not a healthy sign for any, which is not a healthy sign for any company. Correct? If let's suppose company has been using short-term borrowings to finance long-term assets. Now, why a company may want to do this? When the company doesn't have adequate cash. Yeah, company doesn't have the liquidity. Company needs to purchase long-term assets, but the funds are not available. So therefore, these short-term borrowings, which are meant for working capital purposes. What is the objective of short-term borrowing? That is not for a long-term investment. Their objective is for working capital requirements. So instead of using this money for working capital, company is using this for long-term assets. So again, this will disturb the cash position, or you can say the liquidity position of the company. Next, if you see that financial support by the creditors is withdrawn. So in a way, creditors have been asking for their payments. So they are not getting paid. So this is again a situation of what? This is again a situation wherein the company doesn't have adequate funds. Yes or no? If let's suppose there are defaults delays in repayment of loan. There again, you have a similar sort of situation. Yeah, company doesn't have the money to repay the loan. If you look at the operating cash flows, they have become negative. So from the operations, company is not able to generate cash. If you remember the cash flow statement, yeah. So the first part for operating activities, that should generally be positive for a company. Only then it is considered to be a healthy situation. Correct. Similarly, if you look at some of the KPIs, they are adverse. Company has been incurring substantial losses, including operating losses. Okay, creditors are not getting paid on due dates. Further, any new loan company has not been able to obtain. If you look at the position of the company, old loans are outstanding. They are all used. Is they are all consumed by the company. Company doesn't have any funds. Further, for running the business, company need funds. Okay. So the sanctions of the new loans are not available. Okay. So company doesn't have any visibility in terms of future cash. Yeah. Understood. Now, similar to some of these factors, which are financial factors, there could be some operating factors, which may again indicate a significant doubt on entity's ability to continue as going concern. Now, what could be the operating factors? Some of these financial factors we have looked at. Let's look at some of the operating factors. Management intentions to liquidate the entity. So management doesn't intend to carry on. So they are thinking to liquidate the operations, or you can say the significant operations. Company may have 2-3 plants. Okay, let's suppose company has got 2-3 plants. P1, P2, P3. Okay, so these are the large one. P2, P3. Company plans to shut them. Why? Because these are all loss making. Company doesn't have funds. No visibility is there for the future. Directors are leaving the company. So there's a loss of key management personnel, and the new directors, new replacements are all not available. As far as markets are concerned, customers are concerned. Okay, so company has lost out on them. Labor is difficult to be arranged. Company is not getting labor, because without the labor, how will the company carry out its operations? Again, difficult. In terms of procurement, some important supplies are required, means purchases are required. Here again, because operations can't run without this. Yes or no? But there's a shortage of that. Or maybe in the market, competition has increased. Maybe more competitors have come and they are becoming more and more successful as compared to the company. Okay. Yeah. Now, as around some of these events or conditions, let's try to understand as to what is it that the auditor needs to do. Okay. Or in a way, you can say as around the going concern, let's try to understand as to what is it that the auditor needs to do. Priyanshi is asking, sir, due to technical changes, labor difficulties can also be there. Yeah, so there could be various reasons for that, for the shortage. But if that is impacting the business of the company, so that is what we need to look at. Yeah. All right. So let's come back to this. Analyzing and discussing the cash flow, profit, other relevant forecasts with the management. Okay, now in this case, it's important to understand that we are not talking about cash flow statement for the past period. We are not talking about profits of the past period. Yeah, it's all projections. Please understand, it's all projections. So when you look at the future profitability, when you look at the future projections of cash, and who will prepare this? Management, we just discussed. Yeah, sometimes what may happen is, let's suppose on 31st March, you have asked the projections. Okay, let's suppose management has prepared this for next 3 years. 31st March 26, 31st March 27, 31st March 28. In this case, if let's suppose management has prepared the projections for next 1 year, okay, and let's suppose audit has to be completed by 30th September. So in this case, projections which were prepared on 31st March, against that, actual numbers for next 6 months are already available. Yeah. So therefore, it becomes important on the part of the auditor to check in these projections. See, these are the projections which the management had prepared, say in March. Against this, some actual data is now available. So auditor needs to find out whether the actual numbers are in line with the projections or not. It shouldn't happen that the management has projected a revenue of say 250 crore, but actually the sales so far has been only say 115 crore. Yeah, so there's a gap. There's a gap. Yeah, so this comparison of actual comparison of actual versus projections. So this is again required by the management and needs to be performed by the auditor. Similarly, if let's suppose company has got a cash crunch, okay, let's suppose what is the concern, company doesn't have adequate cash, or looking at the financial statements, it appears that the company will not have enough cash. Enough cash means the funds, of course, to run the business. But the management keeps saying, don't worry, yeah, we are about to get a loan. One loan is getting sanctioned from the bank. Okay, so therein it's important to understand the terms of those loans agreements. Why? Because only then the auditor will get to know whether the company will be able to generate funds for the business or not. Yes or no? Yeah, only then he'll get to know. Similarly, as around the minutes of the meetings of the board of directors, shareholders, those charged with governance, those are required to be reviewed, read by the auditor, because therein some of these plans of the management are covered. Inquiry of entities legal counsel. Now, this is again very, very important. See, sometimes what may happen is, let's suppose audit of 31st March is being performed. Okay. Now, let's say on 31st March, a demand has been raised by a regulator. Let's suppose it's a significant demand. Okay. And the amount is such that the company may not be able to survive if the company has to pay this demand. So, therefore, a company may decide to contest that if there are good reasons, good grounds to do that. And how will the company do that? Through the legal experts. So, therefore, inquiring from them. And how do you inquire from them? You roll out confirmations. Further, you can always go meet them. Okay? Wherein you can just understand impact of some of the litigations as to how that is going to impact the business of the company. Correct? Yeah? Now, in this case, when you look at the assessment of the auditor in terms of evaluating various points as to what the auditor should do, what the auditor should not do, yeah, so there are a lot of factors which are required to be considered, or you can say some of the conclusions are drawn, basis which auditor will look at, or you can say come to the conclusion as well as the reporting implications. But I think before that, let's try to look at some examples, okay, through which we'll try to get some more clarity around some of the points that we have discussed. Now, tell me one thing. This going concern as an assessment, should this be made at a standalone level or consolidated level? Tell me quickly. Should this be made at the standalone level or consolidated group level? What do you think? Over to you. Dhanush says standalone. Can you tell me why? So, any response that you provide, can you give me the rationale for the same? If you say standalone, why? If you say console group level, why? Over to you. So, what will be the reason for the same? Over to you. Quickly, at what level should this assessment be made by the auditor? Dhanush says standalone. Priyanshi says standalone because this is the key consideration for the auditor. Dhanush is saying, sir, the meaning of standalone, standalone means if let's suppose there is a holding company, A Limited. Okay, and let's suppose it has a subsidiary company, B Limited. Okay, so the financial statements of only A Limited, only B Limited, or you can say considering only one entity is what you call as standalone. Considering only B, you will call it as standalone B. But if you consider this entire group, okay, wherein A and B both are there, that is what you call as group and not standalone. Stand alone. Clear? Yeah? Dhanush, clear on this? Okay, so now please understand that this going concern assessment has to be done at a standalone level always. Okay. Now let's try to get on to the conclusions. Yeah. Now I think we can just try to understand the conclusion with the help of this flowchart. And with the help of this flowchart, we'll also try to look at the reporting implications. Before I get on to the reporting implications, please confirm if you have understood as to what is this significant doubt in relation to going concern assessment. Somebody asked me, sir, what's the meaning of going concern assumption, appropriate and non-appropriate? Please confirm. Have you understood that part now? Everyone, quickly, please confirm. Yeah, once you confirm, then I think we can just move further. Quickly, yeah. Quickly. Priyanshi is understood. What about others? Almaz has understood. Prem is clear. Very good. What about others? Quickly. Yeah, Neeraj is clear. Very good. All right. So now let's move further. See, at times, what may happen is, let's suppose as an auditor, you go look at the financial statements of the company. Okay. As an auditor, you go look at the financial statements of the company. And what do you find? You find that the going concern assumption is not appropriate. So in this case, what should the management do? Can you tell me? Can you tell me? When the going concern assumption is not appropriate, what should the management do? Tell me quickly. Tell me quickly. If the going concern assumption is not appropriate, what should be done by the management in the financial statements? What is required to be done by the management in the financial statements? Over to you quickly. Prem says disclosure is required to be given in the financial statements. Okay. And what else? What else? See, if the going concern assumption is not appropriate, so this will have to be specified in the financial statements that the going concern assumption is not appropriate. Plus, bring the assets and liabilities to their realizable values. Yes or no? Everyone quickly please confirm. We have discussed this so many times. Yes or no? Yes or no? Yeah. So this is something which the management needs to do. Correct? If let's suppose management doesn't do this, if let's suppose management doesn't do this, going concern assumption is not appropriate, but still they are not giving the disclosure. They are not bringing the assets and liabilities at realizable value. They are keeping them at historical cost. So in this case, will you call that as an error in the financial statements or not? Tell me. Will you call that as an error? Of course, it's a big, big error. Yeah, it's a significant error in a way. Or you can say it's a significant misstatement. Yeah. So therefore, it will be required to be reported by the auditor in the form of adverse opinion. Now, what is adverse opinion? What is qualified opinion? All of these discussions you will have later on in your subsequent sessions. As of now, you can just say that it's a kind of reporting implication which will arise on the part of the auditor. Okay, clear? Clear on this? Yeah, everyone clear? Quickly, please confirm. Everyone clear? So far, everyone clear? Any questions, any doubts? We'll move on to the next part. I think next part is slightly technical. So what we can do is maybe we can take a break now, and after the break, let's continue with our discussion. Yeah. In the meantime, if you have any questions, any doubts, please let me know. No? All right. So let's take a break, huh? Ashok, let's take a break, huh? I. So moving back to that flow chart. Okay, so the other situation. Now, the other situation in wherein the going concern assumption is appropriate. Okay, so if it's inappropriate, but the management doesn't account for accordingly, then of course reporting will have to be done. You can say it's a sort of adverse opinion which will have to be given. But if let's suppose going concern assumption is appropriate, yeah, but there is a material uncertainty regarding the going concern. Material uncertainty means there are some problems. Liquidity is a challenge. You find company has been making losses. Of course, you have received projections. You have received a lot of information through which, as an auditor, you have got the comfort. Okay. So now the concern is not that the company will not be able to continue. Of course, but going concern assumption has become appropriate with certain challenges. Okay, I'm just trying to understand this in a very layman term. Now, what are those challenges? In technical terms, you can say material uncertainty exists regarding the going concern. Okay, so in such a case, what should the management do? Management should give an appropriate disclosure in the financial statements. Okay, wherein the management will explain. It will explain that the company is preparing its financial statements on a going concern basis. Company has been facing certain challenges, maybe in terms of losses, which the company has been incurring, maybe the cash flows or the funding or the liquidity, all of those challenges are which the company has been experiencing. So company will detail out, okay, so that at least the users of the financial statements may get to know about it. But at the same time, it will not have an impact on the going concern assumption. So the going concern assumption will remain appropriate. But of course, the problems associated with that, the challenges which are associated with that, they will be disclosed by the management in the financial statements. So if that disclosure is given, will that be a problem for the auditor now? No, that will not be a problem. Why? Because the financial statements are good to go. The only thing which the auditor will want is to highlight this disclosure. Okay, so you can say in a way, auditor would want that this disclosure gets highlighted. So therefore, in the audit report, there is a separate section which is called as material uncertainty regarding going concern. Okay, so in this section, auditor will give the reference of this disclosure, through which he will in a way just highlight to the users that this disclosure is important for them to read. Okay, but auditor is not doing any sort of qualification. So there's no modified opinion. Some of you may not be knowing about modified opinion, qualification, all of these things. You can just say that auditor is not giving anything negative in his audit report. Okay, so that's how you can just consider it for the time being. Provided adequate disclosures are given by the management. That is very, very important. But what if these disclosures which are required are not given? Okay, so the first situation is disclosures are given. Second situation is disclosures are not given or the disclosure is inadequate. Here again, something negative will have to be given by the auditor in his audit report. You can say he may then give a qualified opinion or an adverse opinion. That will again depend on a situation to situation basis. He will have to evaluate that. Okay. So let me just quickly summarize. There are three situations which are possible. One, going concern assumption is not appropriate, but the management doesn't follow that. So that means it's a big error. So how do you address big error as an audit? Adverse opinion. Second, going concern assumption is appropriate, but the management doesn't disclose that in terms of the material uncertainty which are attached to the going concern assumption. So here again, it's a problem. Why? Because there's a disclosure deficiency, and this disclosure deficiency is quite significant. So that's why it will again invite qualified or adverse opinion. Third, going concern assumption is appropriate and management is disclosing that appropriately in its financial statements, that there is some material uncertainty around the going concern. And auditor is also happy with the disclosure as far as its adequacy is concerned. Means it's properly explained in the financial statements. If that is the case, then of course no negative reporting is required. But somewhere in his audit report, auditor will want to highlight that disclosure. So how will the auditor highlight that disclosure? Through a separate section, which is specifically given for such highlighting. Okay, that is called as MUGC, material uncertainty around going concern. Yeah, so that's a separate requirement, or you can say specific requirement in relation to this, which is therefore required to be covered. Okay, now let's look at some examples, and with the help of these examples, let's try to understand as to what should be the course of action in the given situations. ABC is a manufacturing company. Okay, so this is continuously making good amount of profits and has high dividend payout ratio. In June 23, subsequent to year end. So let's suppose financial year is 22-23. Okay, so this is 31st March 2023. So this is the financial year. So in June 2023, subsequent to the financial year, High Court has imposed significant amount of penalty on the company due to non-compliance of environmental norms. Okay, somewhere over here, a penalty has been imposed. Penalty is so significant. Yeah, it's so significant that it can erode the entire net worth of the company. Management has gone against this penalty. So there's a litigation now. Management has filed an appeal with the Supreme Court. Okay. And management is confident. What is the confidence? That management will win the case. In this case, how do you think you will handle this as an auditor? Over to you. As an auditor, how will you handle this? Quickly. Over to you. So as an auditor, what do you do? How do you go handle this? Tell me. Over to you quickly. As an auditor, how do you handle this? What is it that you will do? What is going to be the course of action on the part of the auditor in the given situation? Yes. Okay, so I can see one response coming up. Prem is saying inquire with the management and legal counselor. But what needs to be inquired? So I think information is available. So what is the inquiry auditor will perform? Tell me quickly, what inquiry needs to be done? Anyone else? What is going to be the course of action in this case? Tell me quickly. What is it that the auditor will do? Tell me quickly. Okay, so let's try to understand this. See, when the audit of financial year 22-23 will be performed, one assessment will be to find out that whether this event should be considered as subsequent event or not. Yes or no? So that's going to be the first consideration. Tell me, do you agree with this? If yes, do you think it will become a subsequent event? Tell me, do you think it will become a subsequent event? Whether that is adjustable, non-adjustable, I'll come to that. Yeah, we discussed that in the previous session. Priyanshi says yes. Prem says yes. See, in this case, first consideration will be to call it as a subsequent event. Yes or no? It will definitely be a subsequent event. Okay, now the question arises that if you call this as a subsequent event, then should this be considered as adjusting or not? Tell me. Should this be considered as adjusting or not? And why? Over to you once again. Should this be considered as adjusting event or not, and why? Tell me quickly. I think we discussed this in detail in the previous session. Yeah? So everyone should be familiar with this. Almas says yes. Prem says non-adjusting because litigation was in June 2023. Priyanshi says non-adjusting. Okay. Now some of you mentioned adjusting, some of you mentioned non-adjusting. Now, I'll come to this response also slightly later. So one is the consideration of adjusting and non-adjusting, which you have done. Okay, and whether that response is correct or not correct, we'll come to that slightly later. Tell me one more thing, that in the given situation, will this event have any concern, any consideration in relation to the going concern assumption? Or if you look at this auditing standard on going concern, what is going to be your consideration? So from the perspective of this auditing standard, yeah, can you just help me understand what is it that you will do as an auditor? Over to you. Prem says yes, because the litigation can erode the net worth of the company. So what will you do as an auditor here? Will you say going concern assumption is not appropriate? Will you say it's appropriate? Okay, because if it's appropriate, there again disclosure may be required. Priyanshi says yes, because it is continuously making profits, gives hint of going concern. So when you say yes or no, I am not clear. What do you mean by yes? What do you mean by no? Are you trying to say that going concern assumption is appropriate? Are you trying to say that going concern assumption is not appropriate? I'm not clear. Please write your answer properly. Huh? As of now, I have not been able to understand. What was your solution? Okay, Priyanshi says going concern assumption is appropriate. Okay, what about others? Prem says appropriate, but there is a material uncertainty. Now, in this case, see, if you look at the company, there's no doubt that its going concern assumption is appropriate. But at the same time, because of this event, material uncertainty has got attached. So no. Yes or no? Material uncertainty has got attached. Why? Because if the company loses the case, then its impact could be so severe that the company may be wiped out. Yes or no? If the net worth is gone, then the company will be completely wiped out. So therefore, in this case, as an auditor, will you say that going concern assumption is not appropriate? No, you can't say that. Why? Because company has been making good profits, paying good dividends. So liquidity, profitability, all of these are not a concern. But this event has created a concern for which appropriate disclosure should be given. If the appropriate disclosure is given, then the auditor will give MUGC, material uncertainty regarding going concern. If the appropriate disclosure is not given, then the auditor may have to get into some negative reporting. Okay, clear? Clear? Okay. So what would be the reporting implication if the management has adequately disclosed the matter in the financial statements? Unmodified opinion, but with MUGC para in the audit report. Para means it's a separate section. It's a separate section which is required to be disclosed therein. Yeah. All right. All right. So now there's one more example around this we'll look at. Just give me a minute. Okay, so let's look at this one. Yeah, so let's look at this case scenario 3. During the course of audit of a company, CA Varun Agarwal notices that company is facing significant skilled labor shortages. Okay, which is resulting in hampering of operations of the company. Yeah. Company's manufacturing is dependent upon skilled labor coming from villages in certain districts of eastern UP. However, due to job opportunities available near villages now, many are not interested in going out from their native villages. Such a situation has led to company not being able to keep its commitments. Commitments means commitments towards the customers, towards the external parties. Company has been losing out on orders. Orders means customer orders because company is not being able to deliver. There's a shortage, of the manpower, and there's a fall in its revenue. Means revenue will of course decline when the orders will be lost. So of course revenue will go down. Fixed costs of the company remain at a high level. Fixed costs have not gone down; they remain constant, and that's the nature of the fixed cost, anyways. Yeah. As a result, company is facing a liquidity crunch. Okay, and is not able to pay its creditors on time. Okay, so there's a liquidity crunch. It's not able to pay its creditors on time. Bankers of the company are also not willing to help the company to tide over liquidity crisis. Auditor is having doubts over going concern status of the company. How should the management of the company try to address auditor's concerns? What audit procedures may be performed by the auditor in such a situation? Over to you. Yes, over to you. Tell me quickly. What should the management do? Number one, what should the auditor do? Quickly. How should this situation be dealt? Of course, by both the management as well as the auditor. Yes. Okay, so I think Prem is saying, so going concern assumption is appropriate, but material uncertainty is there. Okay, what about others? In this case, please remember you are also required to discuss the audit procedures. It's not only about the audit reporting. Okay. So what will you do? Tell me quickly. Anyone? Any thoughts? Quickly. Okay, Priyanshi says management should plan for the future. No, what do you mean by plan for the future? I think you need to elaborate, please. What is the meaning of planning for the future? What plans will be made? Means what is going to, you need to be slightly specific. Yeah. And what is it that the auditor will have to do? Yes, quickly. Okay, so let's try to look at the answer. See, if there is a significant shortage of skilled labor, so I'm just looking at the solution now. So if there is a significant shortage of skilled labor, inability to pay creditors on time, and overall liquidity crisis faced by the company, then what do you call it as? Of course, it is something which is negative. Yes or no? It doesn't reflect in a nice manner. It reflects poorly as regards the performance of the company. Yes or no? Yeah. So therefore, you may say that these are the events, or you can say conditions, which may cast significant doubt on entity's ability to go in concern. Okay, so this is clearly evident. There is no doubt about it. In such a situation, what should the management do? So there were two questions which you need to answer. What should the management do? Management should try to address concerns of the auditor by preparing its future plan of action. So of course, what is it that the management will prepare? Because management understands that auditor will come ask for the future plans. Means how do you plan to deal with all of these things in future? Okay, because past is gone, past is visible. That this is something which the management has, sort of faced. But how the management is going to cope up with all of these challenges in future? For which management will have to come up with projections, cash flow forecasts. Yes or no? That is what the management will have to prepare, because only then, or you can say only through that, management will be able to demonstrate that this is how the situations will improve. These are going to be my sources of funds. Means some of these things will generate cash for the company. Some of these things or some of these activities will result in outflow, and on a net basis, company will have net cash inflows. Yeah, so some supporting documents for those workings. This is what the management will have to prepare. This is what the management will have to work on. Correct? Now, what are going to be the procedures on the part of the auditor? Now, please remember, in the question, you were not asked about the auditor's reporting requirement. If you look at the question carefully, it is not asking you that how should the auditor report this. Question is asking you that what are going to be the audit procedures. So, as far as the audit procedures are concerned, what are the audit procedures? Can you tell me? Obviously, audit procedures will be to check the information which is prepared by the management, to check whether the information available with the management is sufficient and appropriate or not, because only then it will be considered as sufficient appropriate audit evidence. Yes or no? Yeah, all of those things will be required by the auditor. Yeah, so Priyanshi says inquiries. Yes, of course, inquiries will be done. There is no doubt inquiries will be done, but over and above inquiries, some of these workings which the management would have prepared, they will have to be reviewed, they will have to be analyzed, they will have to be evaluated, whether those are factual or not, okay, or whether those are reasonable or not. The assumptions which have been considered in preparing those projections, whether those are appropriate or not, whether those are reasonable or not. Okay, yeah. So these are going to be the audit procedures, because all of these things which the management may have prepared should not be only an Excel file wherein the management is just putting down the numbers. That should have some backup. That should have some basis. Only then it can be justified by the management. Otherwise, what will happen? Otherwise, it will look inappropriate. Yes or no? Yeah? Everyone clear? Quickly, please confirm. Everyone clear? Any questions, any doubts so far? Because with this, we have concluded our discussion on going concern. And please remember that this auditing standard is very important. As far as its practical application is concerned, this is considered to be quite critical. And you can understand as to why this is quite critical, because this can have a severe impact on the reporting requirements. Yeah, so I think Priyanshi has put down a lot of things. Inspection, confirmation. See, all of these wordings that you have used, please refrain from using these words. For example, if in the exam you use these words, this is not going to help you, because these are all generic. You need to be very, very specific and very, very clear while answering this. Yeah, idea is not to just put down everything. Yeah, so that's what you should try to do. Then that's how you should try to practice. Okay, so when you put across your responses, in a way you are practicing as to how to answer these questions. So that's what you should try to do here. Yeah, always, of course. Okay, so any more questions, any more doubts if you have? Please let me know. Then we'll move on to our next topic. Within the same chapter, we'll move on to our next topic. Yes, any questions, any doubts? I think Prem had a question. Prem, you had a question that we should just revise this. So I think we have done a revision, and that is exactly in the line with the module. But still, if you have any further questions, doubts, you may please ask. Huh? Yes, any questions, any doubts? No? All right. So Prem is also clear on this. Okay, so now what we will do is we'll just move on to the next topic. Evaluation of misstatements identified during the audit. Okay. Now, evaluation, all of these things which we need to do as an auditor. Before we get on to that, let's try to understand the meaning of misstatement. Okay. So now, anyone who can just explain meaning of this misstatement? Yes. What is the meaning of a misstatement? Over to you. What do you understand by misstatement? I'm sure you have covered this in your previous sessions. Quickly, what do you understand by misstatement? Over to you, quickly. It's a very, very simple term. Priyanshi says any mistake by the entity which could be an error or fraud. Okay, very good. What about others? Can you also let me know the relevance of a misstatement? How is this relevant to an audit? Why would an auditor look at any misstatement? Means what's the relevance of this term in relation to audit of financial statements? Can you give the background or maybe the thought process which is attached to this? Quickly. What is misstatement? How is this relevant? Quickly. Okay, so let's try to understand about misstatement. In a very simple terms, if you look at the objective of audit, you can draw this, you can say sort of, or you can analyze this. Whenever an audit is performed, what is the objective? Objective is to give true and fair. Yes or no? Objective is to give true and fair view around the financial statements, whether the financial statements reflect true and fair view or not. Okay, so that's the objective of the audit. And in relation to true and fair view, auditor is not required to check each and everything. Or we can say that once an audit is performed or during the course of audit, various types of errors may be found in the financial statements, of course. Some of those errors could be quite significant in terms of amount, could be of not so significant amount. Yeah, but only those errors which are material are the ones which the auditor need to consider. Now with this, another term gets attached, and that is what you call as material. Or you can say another term gets attached to this, and that is called as materiality. Now what is materiality? Materiality, we can say, is a threshold, or you can say is such an amount that if the error exceeds that threshold, and if that is not corrected in the financial statements, so if let's suppose there is an error, that error exceeds a particular threshold, and that error is not corrected in the financial statements, then such financial statements which any user, any stakeholder, any investor will review, yeah, could result in a distorted understanding, in a way that if that error would have been corrected, then the decision making of user could have been different as compared to the decision making which he would do on the basis of that financial statements without the correction, which means it is quite severe. Why? You can just say that users are relying on this, and they may be taking significant decisions on the basis of those financial statements. So that's why you can say it's a responsibility. It's a duty which is placed on the auditor. And what is that? To ensure that financial statements are free from material misstatements. Yes or no? Yeah. So what we have done is we have just gone back to our basics about the audit, about the understanding of audit, about the understanding of audit objectives. Now, let's come back to the same understanding of the basics. Now, in relation to the audit objective, we discussed that an auditor needs to be concerned with any misstatement which is material. Okay. Now the question arises that what do you mean by misstatement? So of course material is understood, but what do you mean by misstatement? So you can say misstatement is what? It's an error. Okay, or you can say it's the terminology that you use for any error or mistake in the financial statements. As simple as that. Now, this error or mistake in the financial statements is what you call as misstatement. Now the point is that this error or mistake could be intentional or unintentional. Yeah, so it could be intentional or unintentional. So it's not necessary that it will be unintentional always. It can be intentional, or it's not necessary that it has to be intentional always. It could be unintentional. If it's an intentional error, what do you call it as? Fraud. Yeah, that is what you call as fraud. because fraud is something which would be done with an intention. Yeah, so that's what you call as fraud. Unintentional is something which is an error or a mistake. Yes or no? Yeah. So this is, you can say, in a very simple manner, an understanding of what a misstatement is. So this is what you call a misstatement as. Yeah. Now, this part is understood that what is a misstatement, and this part is also understood that a misstatement is not always intentional. This can always be unintentional. Both the types of misstatements will have to be considered by the auditor. Now, does it matter whether the misstatement is intentional or intentional? Yes, because depending on the type of misstatement it is, risk of the auditor will vary. Yeah, his risk assessment will get impacted, and of course, his audit procedures are also going to get impacted due to this. Correct. Now, in the context of audit, we have also discussed one point that as far as these misstatements are concerned, okay, so as far as these misstatements are concerned, we are only bothered about material misstatements. Okay, only the material misstatements are what we are bothered about. Okay, and we are not bothered about misstatements which are not material. Okay, now the next question arises that if, let's suppose, during the course of audit, these misstatements are identified or not identified, then what should the auditor do? Yeah. So what should the auditor do? Now, if, let's suppose, misstatements are not identified, say you go audit a financial statements of any company, small, large, medium, and if you don't find any misstatement, though it's practically not possible, yeah, practically it will never happen that there is no misstatement. I'm not saying material one. Immaterial, of course, you will find at least something will always be there. But still, theoretically, let's go with this theoretically. Let's suppose if you don't come up with any misstatement, then do you need to do anything as an auditor? Tell me. Then do you need to do anything as an auditor? Tell me quickly. Anything you need to do as an auditor? Quickly, tell me. As an auditor, do you need to do anything about it? Quickly. If, let's suppose, you go audit a financial statements of, say, PQR Limited, and during the course of audit, you have completed, you have drawn the conclusions, you found there's no misstatement. So as an auditor, what will you do? What is going to be the course of action? Tell me. So what do you do quickly in such a situation? If you were the auditor of that company, what will you do? What is going to be the course of action? Tell me quickly. How will you respond to that situation? Prem says give a qualified opinion. But tell me one thing, that if, let's suppose, there is no error, no misstatement means no error. Why will you give a qualified opinion? Qualified opinion, though we have not discussed, you are going to cover in your subsequent sessions. In a very simple manner, you can say qualified opinion means negative reporting. When do you give a qualified opinion? When, as an auditor, you are not okay with the set of financial statements, or when you want to convey that financial statements do not reflect true and fair. Priyanshi says that in such a situation, he will check that actually the management is lying or hiding something. So, of course, for that, all the audit procedures are performed. And that's how the auditor will check. Yes or no? So, let's suppose everything is done, everything is sort of completed. Now, in such a case, will you get into any sort of investigation? The answer is no. The answer is no. So, it's not an investigation which is going on. If let's suppose you find that there is no misstatement, so what will you do? You will get on to your conclusions. Yeah. Okay, so that's the conclusion, that there is no misstatement. In which case, what will you do as an auditor? You will give true and fair view. Yeah, you are happy, you are saying financial statements are free from material misstatement. Of course, misstatement is not even immaterial, but misstatement is not there. So what will you do? You will say, okay, it's good. So let's go ahead with true and fair view. Yes or no? Very, very simple point. Correct? Easy to understand. Yeah, that's the conclusion that you have. Correct? Absolutely not a problem for the management. Absolutely not a problem for the auditor also. Both are happy. Yeah. Now let's try to understand a situation wherein the auditor finds misstatements. Okay, misstatements are found. Yeah, misstatements are found. Now, in relation to misstatements, once again, we need to go back to our discussion on materiality. I'm sure you would have covered materiality. In case of materiality, you would have seen that one is the materiality. Okay, it's a threshold which could be based on revenue, profit or loss, assets. Yeah, so can you tell me what are the basis, or what are those considerations using which you can just pick up that threshold of materiality? Anyone? Quickly. It's important. So what will become the basis for materiality? Over to you quickly. Prem says professional judgment. Of course, professional judgment will be there. Knowledge will also be there. Technical experience, everything will be there. But what will become the basis of materiality? It will be based on revenues. Yeah, so there are certain parameters: revenue, profitability, net assets, total assets. So there are various parameters. Yes or no? Correct? So now, one point is a threshold that you derive. That is what you call as materiality. Correct? I'm just hoping that everyone is familiar with this term materiality. When you would have covered materiality, there is another threshold. Okay, there is another threshold which is required to be computed and which is required for evaluation, which is called as clearly trivial threshold. Clearly trivial threshold. Are you aware of that? Anyone quickly? You must have covered that when you would have covered materiality. Clearly trivial threshold. Can you please explain what is this clearly trivial threshold? What is the relevance of this threshold? Over to you. Clearly trivial threshold. Okay, this is also called as CTT. Yes. Can somebody explain what is this CTT? What is this trivial? What is this threshold? What is the understanding of this? What do you understand about this clearly trivial threshold? Over to you. Quickly, please. So you can say, once again, it's a threshold which is used by the auditors. See, materiality is used by the auditor for the purposes of reporting requirements. Now, this is very, very important. Now, why is this materiality required? Because on the basis of this materiality, reporting will have to be done. What do you mean by reporting? Means if there is an error or accumulation of errors, if that crosses materiality, then either the management will have to correct that in the financial statements, otherwise negative reporting will be done, which is called as qualified opinion or adverse opinion. That's the relevance of materiality. There is another threshold. What do you call it as? Clearly trivial threshold. Now, where is this used? This is used for selection of samples. This is also used for selection of certain items for examination, for verification. So you can say, again, it's a very low threshold below which, if there are some errors, even if there are some transactions, they can be ignored. Why? Because it's a very, very small amount. So generally in an audit, you don't go and check everything. You do that on a sample basis. But once again, there could be some transaction which could be of very small amount, which you may want to completely ignore. Yeah. So this threshold is that very minuscule, or you can say a small amount, below which some of the things you would want to exclude as an auditor. Clear? Yeah. Now, let's come back to the discussion on the misstatements. Now, these terms were important. Now, as around the misstatements. In case of misstatements, two situations are possible. Let's suppose you come across an error, you find that to be material. If that is a material error, what will you do? You will go discuss with the management. Why? Because this will bother you as an auditor. You will go discuss that with the management. You will ask the management to rectify this. Okay, so this should get corrected in the financial statements. Why? Because if this is not adjusted in the financial statements, then it's a problem. Why? Because you can't give true and fair view. Okay. Another situation is misstatement is found, but that is immaterial. Now, if the misstatement is found, but that is below materiality, so will you then go and discuss that with the management? Answer is yes, of course. See, in both the situations, as an auditor, what will you do? Discuss that with the management. It doesn't matter whether the error is small or big. Discussion with the management will be done for both. Yeah. Why? Because if let's suppose error is below materiality, that doesn't mean that you will want to ignore that. Of course, if that is below your trivial threshold, you may want to ignore that. But if that is above trivial threshold, you may want the management to correct that, because it's always appropriate to bring the financial statements, okay, uh, away, or you can say sort of clear from the errors as much as possible. So this error is not going to bother you so much, but still you want this error to be corrected. The only difference is that if the management doesn't correct this one, if the management says no, this is below materiality, ignore these errors, so will that be okay? Yes, you may still be okay with that. But as far as this error is concerned, if the management says you ignore this error, so will that be okay with you? Not okay. You will want this correction to be done. Otherwise, reporting implications will arise. But one thing is for sure, that before you get on to the reporting implications, before you draw the conclusions for your reporting requirements, you'll always go and discuss that with the management. It will not happen that you have come across errors, you have put down in your working files, you are not discussing this with the management, and you'll just write it in your report. No, that is not how things will work. Yeah, because audit is all about teamwork, wherein audit team is not the only team. Team of management is also a part of team. They work together, and the objective is to make the financial statements free from material misstatements. Okay, wherein the auditor will not work in isolation. Auditor will work together with the management. So that's why discussions as around both the types of errors will have to take place with the management, because it's not only about rectification of the error. Discussion also needs to take place to understand the nature of error. Number one. And to also understand the reason of that error. Okay, so the auditor will want to understand what is the nature of this error. Means, what is this error? So of course, error may be there, but the reason also needs to be understood. Yeah, whether this was intentional, unintentional, all of these things, auditor will get to know only when the auditor will get onto a discussion. And sometimes what may happen is that maybe something appears to be an error to the auditor, but this may not actually be an error. Why? Because auditor may have considered an accounting requirement on the basis of some limited information available to him. Maybe some part of the information was not available with the auditor. When the auditor will go discuss with the management, okay, or maybe let's suppose with the top management, maybe he'll sit with the CFO now. So the CFO may give him some more understanding, may give him some additional documents, on the basis of which auditor may now reach a different conclusion. Something which he was considering as an accounting error, he may find that to be okay. Yeah, because when he had evaluated that at the first place, he didn't have the complete information. He didn't have the complete understanding. He didn't have the complete background. Yeah. Yeah. Sometimes what may also happen is that there could be a difference of opinion. Yes or no? There could be a difference of opinion. Now, what do you mean by difference of opinion? Tell me, anyone? What do you mean by difference of opinion? Yes, quickly, anyone? What is the meaning of difference of opinion? At times, what may happen is that on a particular transaction or an event or an arrangement or on a contract, the way accounting is done by the management, the way reporting is done by the management, auditor may have a completely different view. Possible or not? Because at times there are certain areas over which judgment is required. interpretation may be required. Yeah. So the intent of the management is not wrong. Intent of the auditor is again not wrong, but their thought process could be different. And that's why there could be a difference in their views in relation to that reporting which has been done in the financial statements. Okay, in such a case, what needs to be done? In such a case, once again, this discussion will be required. Why? Because when the two parties will sit together, management, auditor, when they will sit together, they will understand. Okay, then they may sort of deliberate on this matter, on that particular transaction. It may happen that there is some alignment in terms of their conclusions. Yes or no? That is possible. Maybe the management is able to add something to the auditor, basis which his view may change, or maybe the auditor is able to put across his viewpoint to the management, and the management can understand that yes, the conclusion reached by the auditor was correct, and something which the management has done is not correct. Yeah, but that's possible only when the discussion will take place. Okay, so therefore, the first point after coming across any sort of misstatement will be what? Will be to get onto a discussion with the management. Okay, so there has to be a communication from the auditor and the discussion with the management as around that particular error. Yeah, so that the auditor can get onto these things to understand the nature, the reason. And why is this important? See, one, of course, as we discussed, to reach the conclusion, this is important. Plus, another point which is important. Let's try to understand that. On the basis of the nature, on the basis of the reasons, auditor also needs to get into his risk assessment. Now you may be thinking, but sir, risk assessment is already done. This planning is already completed. So what do you mean by risk assessment? See, the risk assessment over here means that during the course of audit, if the errors have been observed in relation to certain areas, those errors are quite significant, or maybe the nature of error is such which is impacting the auditor or which leads to some of the additional risks as far as the audit is concerned, then the auditor will have to chalk out his audit strategy. Or you can say auditor may want to add something to his audit strategy. He may want to bring in some changes. Yes or no? Yeah, all of these things are important. Why? Because again, on the basis of this additional risk assessment, or you can say risk assessment during the course of audit, what will happen? Auditors' responses what do you mean by auditors' responses? Auditors' procedures may increase or decrease or may change, which need to be planned. Initially, auditor may have thought that employee cost is not a significant risk. But during the course of audit, auditor has found that there are a lot of errors, immaterial, but a lot of errors in this particular cost or in this particular expense. So what will he do? He may want to reassess that. He may want to increase his extent of testing. Yes or no? Yeah. So some of these things are required to be considered by the auditor. Clear? Yeah. So I think up to this, we can just, sort of close. We are not yet done with this topic. So we plan to continue with this topic But now I can just come to your questions, doubts before we wind up our today's discussion. Over to you. Any questions, any doubts that you may have? Okay, so I can see responses from Kavita. Any questions, any doubts that you may have so far? No questions? All right, so then I'll request that before we meet next, just make sure that at least this part, of course, the previous part you should revise, but at least this part in relation to the misstatement, make sure you revise before we meet next so that there's a connectivity. Okay, yeah. And thanks everyone once again for your time today. And once again for this participation that you've shown. Thanks so much. Yes, yes, sure.